Good morning, everyone. I'm just testing my mic. Can everyone hear me?
Yeah.
Great. That's good. For some of you that may know that this session is going to be recorded, so I'm going to make it available on LMS as well as all the questions and solutions. So don't worry about copying them down per se, but take this like seriously and think that you're actually sitting in an exam and you would have about roughly an hour and a half. But of course, we're going to probably take about 2 hours to finish this. And we're going to start in about 1 minute time.
I'm here. What's up? I can't hear anything. Why can't I hear anything? Oh, this is the worst. Oh, no, now I can hear you. That's great. Which exam is this? 2018.
All right, everyone, it's 10 o'clock. So should we start? So well, first of all, welcome everyone. Thank you for coming to dining into this very special mock mismatch exam that we never planned to have. So this is based on an actual past exam paper back in 2018. And so a student would have 90 minutes, and here are some instructions that you may want to read it. This is what you would have, and this is probably what you will have in the final exam as well. So even though it's a closed book examination, but everyone is allowed to bring in a two-sided A4 sheet of pre-written personal notes, which is also known as cheat sheet. And we have about 20 MCQ questions, each worth 2 marks, and there will be 2 short answer questions. All right, without further ado, I'm gonna start going to question 1. It's page 2. All right, so multiple choice. Each question only have 1 choice. Single choice question. So I'm gonna start a poll. So once you finish that question, tell me what the answer that you think will be.
We can't. You can't actually submit that until all the questions are answered, I think.
Oh, really? Oh, well. I mean,
Yeah,
that's completely useless then. Sorry. I mean, I was testing this function the other day with just one question.
Let me just select an answer for everything. I'm going to get like the worst score. Yeah, you have to. We would have to go through the first 10, and then. So why don't we do that? Why don't we just go through the first 10, and then we can revisit 1 through the 10 at the end of it.
All right. So that should be enough time for question 1. All right, question 2. If for some reason you can't see the screen, please definitely message me so I'll make sure everyone can see the question. All right. Question 3. All right, question 4. Question 5 there when you're ready. All right, question 6. Seven and 8. All right, question 9 and 10. All right, how are we doing with the first 10 questions? Do we need more time? All right, great. Feel free to put, someone asking, will we get a copy of this exam answer on LMS? Yes, you will. That's the answer. Yes, you will. All right, let's just go through the answers and you can grade yourself. Each question was 2 marks. The total mark for this exam paper was 90. So which means given a 90-minute exam with 90 marks, 1 minute per mark roughly. All right, question 1, the distinguishing feature of a corporation, it is that the legally defined artificial entity separate from its owners. So what's wrong with ACD? All right, A, there's no legal difference. There is no legal difference, there is legal difference. It provides express liability. No, is limited liability and provides limited liability only to small shareholders. That's not right. It's equal for all shareholders. Question 2, the answer is D. Which of the following statements regarding law of one price is incorrect? An important property of the law of one price is that it holds even in markets where arbitrage is not possible. So you may recall in your in week 3's lecture with Daniel that the law of one price is not possible if the arbitrage is not possible, right? Because if people see the price difference and they can't buy low and sell high and arbitrage it out, then you won't observe law of one price. Question 3, which of the following statements regarding arbitrage and security price again is incorrect? So the answer is C, when a bond is underpriced. Underpriced means if the bond should be selling at say 900, but it's only $850, which means that's what you mean by underpriced. The arbitrage strategy involves selling the bond and investing some of the proceeds. That would be the opposite, because if something's underpriced, that means it's below its fair price, which means that becomes relatively cheaper. So but in buying low and sell high in arbitrage strategy, you will be buying the bond rather than selling the bond. All right, question 4. Which of the following statements is false? This is a tricky one, I have to say. The answer is C. C is false. We cannot separate a firm's investment decision from a decision of how to finance the investment. This is one of the big takeaways from week 3. So the reason why a firm's investment decision should be separated and can be separated from how to finance it is because when a company is trying to raise capital, they can either do by selling bonds or selling shares. what we assuming here is that the bond will be always correctly priced by the market, so as with the shares. So which means that they should separate its investment decision on how to finance it, so from how to actually sell this product, because there's no way for them to get an extra profit from selling these bonds, would always be correctly priced.
Yeah, that question's the worst.
All right, and then question 5. Daniel, do you want to talk about question 5? Because I just have to pick up the call.
Okay. So you are a shareholder in a corporation in Australia under the imputation tax system. Remember we talked about the double taxation and imputation tax system that we have in Australia, and we get our franking credit. So we recall that essentially what we end up paying is our effective tax rate after we get that franking credit back, and that franking credit work to offset the tax that we had to pay. So you're a shareholder in a corporation in Australia under the imputation tax system. This corporation earns $4 per share before taxes. After it has paid taxes, it will distribute the remainder of its earnings to you as a dividend. The corporate tax rate is 35% and your personal tax rate is 15%. The effective tax rate on your share of the corporation's earnings is closest to a 15%. I mean, you could have calculated it if you wanted to, but I suppose that if you knew how the imputation tax system was working, that you would know that it would be 15%. It would be your marginal tax rate at the end of the day.
That's right. So you shouldn't spend more than 20 seconds on this question. All right, move on to question 6 and 7. Feel free to go in your own pace, but we're going to discuss question 6 first. Why in general do financial managers make financial decisions in a corporation rather than the owners? Well, for a corporation, there will be many shareholders. So who would you listen to, right? And that's the main point. There are often many owners. And
what about C?
Yes. The interest of various owners may conflict with each other. I mean, that's also correct as well. I mean, but then here, what is the but what is the main reason for this? So I mean, it could. I mean, so question C is generally correct. The interest of various owners may conflict with each other, but doesn't have to be. But the main thing here is that, but the main point was that there are many owners. Anyone can buy and sell a like a listed company, right? So your ownership can change rapidly.
I mean, if you scroll to the top, and this is where you'll see, isn't there written at the top right before the MCQ questions? Choose the one alternative that best completes this. You'll see this in exams as you go forward. It's always going to be the one that essentially the best answer. Yeah, that's the. It's something to keep an eye out on.
Yeah.
Keep an eye on.
Oh, excuse me. Why is option D wrong?
Because they are not disinterested third party. Because typically speaking, for a financial manager, they get their salary and remuneration from this company, right? So they are not exactly disinterested third party. So which means, I mean, so technically speaking, this statement will be correct for the corporate board. So let's say when a corporation have a board of directors, it will be best to have some what was the term for the non-executive directors. That's my point. For non-executive directors to be disinterested third party to overlook at the management. But in this case, the question is asking for the financial managers, which means like CEOs, CFOs, and they are not exactly disinterested. So that statement is not suited for these answers when you talk about financial managers.
Do you remember when we talked about agency theory? Or yes. The agency problem? Yeah. So essentially there's this conflict between those who control the company and those who own the company. So shareholders own the company and the managers control the company. And we talked about ways to incentivize the managers such that we could align their interests, such that they were in the interest of shareholders, or more aligned with the interest of shareholders, so that they would operate to maximize the wealth of the firm rather than their personal wealth.
All right. So question 7, feel free to stop us at any time. Question 7, which of the following statements is false? By convention, the coupon rate is expressed as an effective annual rate. That one is a wrong statement because it's expressed as an APR. So when you have semi-annual coupon, the coupon rate is just divided by 2. All right, question 8. Which of the following statements regarding the income statement is incorrect? So this is your knowledge from week 2. The income statement shows the earnings and expenses at a given point in time, and that one is wrong because the income statement tells you, statement B really sort of describes the income statement, is earnings and expenses generated between 2 days. So what will be a statement that's expressed at a given point in time? That is your balance sheet. That tells you at one point in time, 31st of December 2019, what your company has at that moment. Doesn't mean your company will have the same amount on 1st of Jan 2020, which is the beauty of balance sheet. Doesn't really tell you much.
Yeah. So just remember the income statement, for example, if you want to think about it this way, the income statement, if you think about revenue, it's just telling you how much revenue did you make that year, how much expenses did you make between this year and last year, and then what was your profit between this year and last year. Whereas your balance sheet is all the assets that the company has as at today, and all the liabilities it has as at today.
All right. Question 9. As I promised in the lecture 2 recording, if there's any question related to accounting ratios, the formula will be provided. As you can see, here is provided. Questions after for the price earning ratio, just in case people don't know what that is. So even elaborated what that formula is: market cap divided by net income, or share price divided by earnings per share, because the common factor is total number of shares. In this case, it's pretty straightforward. You have the share price times number of shares outstanding divided by net income. All right, 21.85, that's the answer. And question 10, use the following information for EC Incorporate. If EC's shares are currently trading. So the formula is given: market value of equity divided by book value of equity. So market value of equity is just like market cap, share price, times number of shares, 24 times 25 million. Don't forget about it as a million, divided by $100 million worth of book equity, which is the answer is 6. All right, how are we going with the first 10 questions?
Did your polling thing work?
I'm not sure. Let's see. All right, so I can see the poll for question 1. Most people answered B, which is right, and 66% answered 2 correctly. Question 3 is C, correct, about 57%. Question 4, the answer is C as well. 69% people answered C. Question 5, the answer is A, about 80%. Question 6, 64% answered A. 33% answered C, but the correct answer is A. Right? Question 7, answer is A. 69% answered A. Question 8, 61% answered correctly A. Question 9, 94% answered B. I'm glad to see that. And question 10, about 81% answered B. C, sorry, C is the answer. All right, so let's move on to the next 10 questions.
I think that's pretty good considering, I'm guessing most of the 87 participants haven't actually done a whole lot of revision for this mock exam like they would with a mid-semester exam. I think that's pretty good.
Right. All right, I'm going to launch polling for the next 10 questions, and we're just going to go through each question. I'll let you have a go at each question. All right, I'm going to go to question 12, 13, and 14. All right, 13, 14, and 15. All right. Do we need more time for question 15? Let's move on to question 16 and 17. All right, 18 and 19.
Can you please show the question for 17?
No worries, I'll do that.
Thanks.
No worries.
Someone's asking if you can scroll up to 16, Georgia.
All right, sure. I mean, you can take a screenshot and just append it to Word document if you want.
If you want to hint, you don't need to do any calculation for 16.
Yeah. All right, moving back to 17, 18, 19. Do we all need more time for question 19? All right, question 20 is irrelevant. So let's just go through the answer, shall we? All right. Okay. Feel free to put your answer onto the polling. Yeah, we can see 19 and 20. 20, question 20 is irrelevant. For Michael, Christy, how can we check our answers after we submitted them? Or we will go through the answers together. We have 30% people submitted their responses on the polling. I mean, really, the polling just to help you get an idea about what your peer is doing. All right, let's go through each question. Question 11. Which of the following methods will provide a correct analysis when dealing with nominal cash flows and real cash flows? So we talked about this in week 5. So the basic takeaway from that, it was nominal cash flow divided by nominal interest rate and real cash flows divided by discounted by real interest rate. So over here, the answer is C. And about 68% people answer C, which is good. Question 12, when a product trades in a competitive market, what determines the value of the good? So here is coming from your week 3 is the price that determines the value of the good in a competitive market. That's the definition. And this question, 55% people answered D.
How many people chose A?
So 33%, 1/3.
Yeah, I remember going through this question a lot, or students choosing A for this question a lot. But I mean, when I asked them, why would demand determine the value and not supply? It was so kind of met with couldn't really answer the question. But yeah, no, it's price.
All right, 13. Which of the following statement regarding growing perpetuity is false? We assume that R smaller than G for growing perpetuity. No, we did not assume that. Because if R smaller than G, then that growing perpetuity will become an infinity number, right? So here it looks like it's correct, but that's the one that usually tricks people. And we have the question 13, 76% people answer correctly. All right, for question 14. You're thinking about investing a mine that will produce $10,000 in first year. And it's getting harder to extract them. So you think that the rate of the ore is going to be declining at a rate of 8%. So declining means we'll be growing at minus 8%. This is very similar to one of our MFL, My Finance Lab question. If the appropriate interest rate is 6%, then what is the value? So here will be 10,000 divided by R minus G, where G here is minus 0.08. So it should be 71,000. And question 14, 62% people answer correctly. Question 15, which of the following statement is false? And is D, the annual percentage rate indicates the amount of interest, including the effect of compounding. So think about how we define, for example, when we say 12% per annum compounded monthly, that's another way of saying 12 divided by 12 is just 1% per month. So how we define API is simply times 1% per month times 12, which means in that case, essentially, we are assuming there's no compounding, which is not true, right? So which is why that's just only a way of expression. So APR expressed interest, simple interest in 1 year. So no compounding. So D is false. And about 55% people answered correctly. Question 16. Consider the following statement. Which one give you the highest effective rate of return? So you can actually do the conversion of APR to EAR in this case to compare them fairly. But you may recall that when we discussed the APR in week 5, we're talking about APR is essentially a way to lower the effective annual rate, right? And the higher the compounding frequency, in this case, the higher the corresponding EAR. So you can so in this case, it should take you to the answer straight away, which is daily. So that's the one gives you the highest compounding frequency. All right, let's see the polling. 81%, which is good. 81% answered correctly, B. Question 17, which of the following statement is false? B is the correct answer. Real interest rate indicates the rate at which your money will grow if invested for a certain period. So nominal interest rate is the one that measures your money will grow, the actual amount. But real interest rate is the one that measuring your purchasing power. So 17, 47%. So this is the first one that we have the answer, the correct answer less than 50%. So 47% people answered B. Question 18. Question 18 is probably the one that actually requires you to get your calculator out. So you're given the MPV is $2,278. And here is the cash flow. Cash flow at time 0, at 1, 2, and 3 with an interest rate of 10%. So basically, if you write them out like this, sorry, someone paused me. Someone asked a question about why does real interest rate measures purchasing power and not the nominal? That's how we define it. So nominal interest rate is saying when you're given an interest rate, that just tells you what money will get. But it doesn't really take account of inflation, which means it's separated. So the bank can give you 10% interest for your term deposit, but it doesn't guarantee that in 1 year time, you'll be able to buy 10% more goods compared to today. And that's the very definition. So the real interest rate measures your purchasing power, but the nominal interest rate measures the actual dollar amount. Right, so that was 17. No worries. 18, just to rearrange it to solve it. So setting the next to be in year 2 cash flow. So I have the equation there. Don't worry about copying this down if you're not sure, because all this is going to be provided, uploaded on LMS. It's important to see how you guys go. Question 18, 61% of people answered B. So for those 39% who didn't answer correctly, think about maybe you got a sign wrong somewhere, right? So $28,000 is happening in year 0, which is there's no interest. Don't have to divide it by 1 plus 0.1. All right, so question 19. Question 19 is probably the trickiest. Which of the following bonds due to maturity can be solved without any calculations? So here, the keyword is without any calculation. So a 10-year zero coupon bond with face value of $7 currently trading at $8.50, right? We discussed in the lecture note that for zero coupon bond, we can calculate due to maturity. But in this case, we can't calculate it without any calculation, if you know what I'm saying. So here, what you have here is face value is 1,000 divided by 1 plus utility power to 10 equals to 850. So you still require, so you will still require a bit of calculation to do that, right? You need to get your calculator out to do the log. But for option B, a 15-year bond paying annual coupon rate 10%, currently trading at $1,000, which is the same as face value. So that's a takeaway. That's a hint to telling you when the face value is the same as price, the coupon rate is the same as a yield to maturity. So, right, so statement B is the one that you can be solved without any calculation, right? So let's see what everyone answered for question 19. So question 19 is almost one, equal across all choices. About 33% people choose A, 31% choose B, and 24% choose D. But the correct answer here is B, right? The trick part is that can be solved without any calculation. I'm just checking the chat message, right? So a student asking, saying, other than the MFL test, how else can we find practice questions with solution? So we'll talk about that at the end, about the additional exercise that you can do. And question 20 is irrelevant this year because this is not 2018 semester one. So when I usually run a lecture, I will try to bring something as a surprise prize every week to encourage participation, and it goes alphabetically. So this one was almost answered 100%, for people who attended, because A, B, C, D, week 3, that would be C, right? Chips.
Yeah, I just gave them tiny teddies, so.
Good enough. All right. So okay. So that was the MF. That was the multiple choice question. The average in 2018, which I believe is very similar to every year, is around 60%. So if you get 60% correct in out of these 20 questions, that means you're beating the average across in compared to the past year. All right. Now we're gonna go to the 2 short answer questions. All right. So we'll go through this question together. We'll read out the questions, and you can have a think for each question. So question 21 is a bond question. So how about I let you read a question first, and then read question A, part A. I think that was the best way to put everything on one screen. All right. The recording will be available on LMS later. right? So that's the question part. So basically, it's just a coupon paying bond, with, with a bit of context in between Batman and Joker. So part A is saying, what are the next 3 coupon payments and when will they be paid out? So basically, the question here is saying coupon rate is missing, right? We don't know the coupon rate, but do we know the yield to maturity? Yes, we know the yield to maturity. So in this case, the yield to maturity is determined by its credit rating, which is AA, 5%. And given the bond is issued at par, par means the yield to maturity is the same as the coupon rate. So for this semi-annual coupon, what will be the coupon payment and what will be the date for them to be paid out? Let's just do this together. Well, so most people will be able to get it right, which is the coupon rate equals to yield to maturity, because that is at par. So, but they may miss out information here is a semi-annual coupon, so which means with a 5% yield to maturity and coupon rate, each coupon is 2.5% because it's twice a year, 2.5%. So 2.5% of the face value will be $25,000. So which means for the next 3 coupon payments, each one will be $25,000, $25,000, $25,000. The date here is that is based on your understanding about whether you know the coupon payment is actually paid right at start or at the end of the first period. So for a typical coupon paying bond, the first coupon payment will be paid out at the end of the first period, which means given today is January the 1st, 2018, that will be at the end of the first period starting from 1st of Jan, so that will be 6 months away. So either 30th of June, 2018 or 1st of July, 2018. So that both answers are acceptable. And the second one will be essentially 6 months after the first coupon date. 31st of December 2018, 1st of Jan 2019. And the third one will be 6 months after that, 30th of June 2019 or 1st of July 2019. So this question is being allocated with 8 marks. So as you can see that this is like a big giveaway.
It's a big giveaway question, but what I found in the past is that I think students just try to do it too quickly. And particularly with the dates is that they get the dates wrong. Because they'll see 1st of January and they won't think about when the first coupon payment's being paid. And they'll just say 1st of June, 2018 as the first payment, which of course would be wrong. Yeah. So I think it's just a lesson that, you'll come across questions that seem quite easy, but please do take the time to read the question carefully.
Thanks, Daniel. And then we can work on question part B. There are 3 parts in this question. I mean, each question will specify that it will be a total of 3 parts. Someone asked me a question. When you said, does that mean there are 2 answers per box? I mean, or it means that they're both acceptable. Yeah, Daniel just answered that. So you can either answer 30th of June or 1st of July, doesn't matter. But if you're writing for some reason 31st of June, that wouldn't be acceptable because that date doesn't exist. All right, so for part B, exactly 3 years later, you can read that question.
You're on the solutions, by the way.
Oh, sorry. And here's the question again, if you need any information. All right, there should be enough time for that part, even though there's a mark question. So the trick of this question is twofold. First of all, it's exactly 3 years later, just after the coupon payment is made, which means given that was originally a 10-year bond, 3 years later, that means you only have 7 years left. And after a coupon payment is made, means your next coupon payment is exactly 1 period away, 6 months away. And the second trick is the credit rating. So the credit rating for the Batman's coupon paying bond increases from AA to AAA. So that means if you go back to the question, so here we have if you assume he's selling at par, we're no longer assuming he's selling at par because, so someone asked this question, do we still assume he's selling at par? So here it talks about the basic concept of coupon paying bond is that the bond seller will be, which means the issuer, the company, the Batman here, he would sell the bond right at the start. And once he issued that, it's no longer relevant. So the bond price is no longer determined by the initial transaction. So which means that when you talk about the sellers of the bond, that will be the holder of the bond. They want to get rid of it, they will sell to someone else. It's not sold by the Batman anymore. And in this case, given its raised to AAA, that yield to maturity will go from 5% to 4%, right? So that's the second trick of this question. So which means you need to work out the yield to maturity is now 4%, which is 2% per 6 months. And given you have 7 years remaining, is 7 times 2, 14 payments. So the coupon rate, you can either take it from question part A, which is originally selling at par, that means 2.5%. And if you use that number, the price here is simply just applying the formula face value times the coupon rate, which is $2,500. That's each coupon payment, divided by the yield to maturity is 2%, times the formula here, the annuity formula, and power to 14. So that's power to 14. 14 payments left, plus the face value divided by that. So that what gives you that price, about 1,060,000, right? That's one alternative. The second alternative is that if you couldn't figure out the coupon rate from part A, you're not going to be double penalized. I would say if you couldn't figure it out, you would use 4%, right? So the coupon rate would be 4%. Alternatively, if you use coupon rate as 4% per annum, then with the new yield to maturity being 4% as well, the price is the same as the face value. Or you can do the calculation. You don't have to. You can just say that. So it doesn't really matter which way you want to go with.
And if the students in this question, they used 4% and they calculated it as you did there, would they get full marks for this question?
They will.
Cool.
Yep. So you know, there wouldn't be any follow through marks. We were trying to minimize that, right?
Yeah.
Okay. So that's for part B, and part C is here. So part C is separated from part A and part B. It's in the same context, but the question is on sort of accounting perspective. All right, let's just go through question part C together. This question is very similar to one of the MFL test 2 questions. And in fact, you have that into your tutorial as well. But this one tends to confuse people a lot because we didn't spend enough time on accounting and we never really, accounting was never our focus anyway. So this one requires you to have a bit of understanding about the income statement as well as statement of free cash flow. So in this case, if you did the MFL test 2 by yourself, you may recall that it was a question about this. So they purchased this machine. So the capital expenditure does not go into your income statement. So the impact, well, first of all, to work out what's on your cash flow, you need to work out what's on the impact on your net profit. So in this case, the net profit will go down by, so here is a depreciation, so minus 15, that's the minus 15 every year, times 1 minus 0.3, 1 minus 10.5, and that adds back 15, tells you that this depreciation is like a tax chute for you, which means when you depreciate your equipment, you get a tax benefit out of it. So, and that amount is essentially the depreciation 15 multiplied by the tax rate. So which means essentially when your equipment start depreciating $15 million per year, that means you will get back $4.5 million back from the tax office. But the question is after your cash flow. So in this case, in year 1, your cash flows will go down by $16 million because you know that capital expenditure is a cash transaction. You pay that amount, but then so minus 60, but then you add back 4.5 as a tax benefit. So the net effect for year 1 is minus $55.5 million. It's important for you to include million, right? For year 2, year 3, and year 4, the capital expenditure is no longer relevant. The only item reoccurring will be the tax benefit coming from this depreciation, which is this, essentially 15 times 0.3, right? That's another way of saying 15 times 0.3, $4.5 million. So that's a tax benefit you would get every year. Let me check the chat message. So Sam asked me a question saying, will the final exam be 50-50 with topics meant for the mismatch exam and topics in the final exam? So we haven't actually finished writing the final exam yet. So, but then because of the optional assignment that covers content from week 1 to 9, the final exam probably have a slightly higher percentage allocated to the second half, if that makes sense, slightly higher. And Naomi saying, are these the steps you will always do for these kind of questions? You don't have to. You can just simply write down the tax benefit coming from depreciation being 15 times 0.3. That's fine, because that's what I essentially writing over here. You don't have to write exactly like what I write here to get full marks. Yes, so May saying, if I just roll 16 minus 15 times 0.3, yeah, that will be given full marks as well. All right, so now we come to the last question in your mismatch exam. So I'm gonna just give you the question for part A and part B first. Question 22 is slightly, sort of unconnected, disjoint, compared to question 21. All right, let's go through these two parts. So part A, on the orientation day, he was walked past the booth. So do you agree that Harry is qualified to join his club? Please write agree. So over here, the correct answer is agree. So that's what the question tells you to do to get the 3 marks. And if you write disagree or not sure or whatever other stuff that you write, it will be 0, right? This is just to ensure that everyone can work out and no one will get 0 marks. For part B, after joining the SCAR club, Harry's being offered a scholarship with an unusual payout structure. So he will get $520 every 21 days, every 3 weeks. The first payment will be made at the end of the first period. So this is like an annuity. The last payment will be made on the day he graduates from Hogwarts, which is exactly 3 years from today. What is the present value of this scholarship? So the interest rate here is 6% per annum EAR, and assuming that there were exactly 52 weeks in 1 year, and include the timeline. So over here, this is a very typical like present value of annuity question. The trick here is the interest rate, right? What interest rate you're gonna working with, and then maybe also the end here, how many payments in total. So the interest rate here is that given the scholarship is paid out every 3 weeks, you need a 3 weeks rate. So you can either working out 3 weeks based on 365 days for 21 days. So in this case, there are 2 ways for you to work out interest rate. They're both acceptable, even though they lead to slightly different answers, but they're both acceptable. So you can either think about, okay, my 21 day is that 1 plus the monthly, the periodic rate, power to how many periods per year? There will be 365 divided by 21 number of 3 weeks period. That will be equivalent to EAR as one way to solve it. Alternatively, you can just say here, because given that we are assuming there are 52 weeks in 1 year, so that means there will be 52 divided by 3 number units of 3 weeks period per year. And you can see that the 3 week interest rate is either 0.0033 or 0.00336732. Why will we not need to convert it to an APR? So in this case, we don't need to convert to APR because APR is just an expression of interest that for people to easily communicate with, right? So the interest rate that we always of interest is the periodic interest rate that matches with the frequency of the cash flows. In this case, given the cash flow is paid every 21 days, then we actually after the 21-day interest rate, right? So typically what you would get is the question will give you an APR, but in this case, the question give you an EAR. The trick here is to convert from EAR to the periodic interest rate, right? You don't have to solve for APR. And once you work out the interest rate being either one of two, they're both acceptable, and then you need to work out how many payments in total. So there will be 3 years of 21-day payments. So which means it's 3 years of 3-week payments, given each year has exactly 52 weeks. So it's 3 times 52 divided by 3, and that tells you there will be 52 payments in total. Once you work out interest rate and end, the rest is just applying the formulas. So remember to draw a timeline. The timeline is like this. Starting from today, 0, my first payment will be at the end of the first period, being 3 weeks. And the payment amount will be 520, which is the same all the way into the last payment, 520. And the last payment will be made after the 52nd payment. So if you're using the first interest rate, using the present value of annuity formula, payment divided by the interest rate plus 1 minus 1 plus interest rate power to minus 52, you will get 24,772 or 24,766, depending on which interest rate you use. But they're both acceptable, right? So if that's what you write over here, you'll get 10 marks. And if you couldn't get the interest rate out, say you screwed up in the interest rate, but you are able to work out the rest. For example, you work out the number of payments and you know how to use the formula, you probably will get about 6 marks or 5.
So if I'm doing this question and I just have no idea what to do with the interest rate, should I make up an interest rate and then go forward? Or
I mean, yeah, that's right. So that means we won't double penalize you in the later section, where if you couldn't work out interest rate, you can use whatever interest rate you assume in part B. And the student asking, saying, why is that 520 divided by R? So 520 divided by R is another way of saying 520 times 1 over R, which is just same as 520 divided by R. That's just a part of the formula. You should be rounded to 2 decimal places because that's what the requirement is at the start of the question. So if you, sorry, let me scroll back. So I think at the start of the short answer section, I would say only round your answers to 2 decimal places. And that will be by default for your final exam as well. So all the requirements written down here. All right, if you have more questions regarding this part, someone asked me saying, say if you got 24,767, which is about like $1 away, that should be acceptable because really we're looking at your following steps. So if you did your interest rate correctly, because you may not leave as many decimal places as I did over here. If you only leave 5 decimal places, you will still be acceptable. Given here is part of 52, that may lead to some non-marginable errors, but that will be acceptable. When someone asking saying, when will this be uploaded to LMS? When I finish this?
There's another question.
Yeah.
What would we need to do if given an APR instead of an EAR?
So if we're given an APR in this question, you will be careful about what kind of frequency it will be. So let's just say here, if someone gives you, in this question part B, if the question gives you an APR of say 12% per annum compounded 3 weekly, then that means you will just simply use 12% divided by number of periods, which in this case, that will be 52 divided by 3, right? You took to get it into the 3-week rate. But if the question gives you an APR, which is 12% per annum compounded monthly, then you still need to find out a 21-day period because that APR would just imply a monthly interest rate, but you will still need to convert from monthly interest rate to a 21-day. So after all, you don't need to worry about whether it's EAR, APR, or whatever. What you do care here is the periodic interest rate that matches with the frequency of a cash flow. So if the cash flow here is $520 every 21 days, then that is the keyword. That means you need an interest rate for every 21 days, right? On a 3-week period. All right, so that's part B. Now moving on to part C. All right. So part C, let's look at it together. So in this part C and D is no longer related to part A and B. So part C, Voldemort taken out a $100,000 loan with 12% APR compounded monthly. And the first loan payment is due exactly 1 month from today. And the loan is this is the trick, the loan is a 4-year loan based on a 10-year amortization. Just in case people are not sure what that is fair enough because I never talk about it. This means that the loan payment will be calculated as if he will take 10 years, i.e. 120 months to pay off the loan, but he actually must do so in 4 years. To do this, he will make 47 equal payments based on the 10-year amortization schedule and then makes a final 48th payment to pay the remaining balance, right? So this question is being allocated with 6 marks, but as you can see from my answer over here, it's very straightforward. It really testing your understanding about understanding this explanation over here, because no one really knows about 4-year loan based on 10-year amortization. It's based on whether you can interpret what follows through. So here, what will Voldemort's monthly payment be in the first month, which means in the first one of the first 47 payments, given it's going to be a monthly repayment, the interest rate of interest here is 12% divided by 12, APR compounded monthly, it's 1%. And the present value here is the loan amount. He take out a $100,000 loan, and that equals to payment times 1 over R times 1 minus 1 plus R power 2. So here is 120, right? Because this is the special structure of this loan. It's a 10-year amortization. So which means you will be assuming as if he would take 120 payments to finish the pay. So that will become payment divided by that. So the rest is just to work out what the payment is. So 100,000 divided by the annuity factors with 120. So each payment is 1434.71. Right? So you can see that the calculation is rather straightforward. Once you understand, all I'm saying here is that even though it's only a 4-year loan, but for the first 47 payments, you'll be assuming as if he pays off this on a 10-year amortization, which means you'll be spread it out as to 120 payments. And that leads us to the last question. Is what will Voldemort's final payment be, the 48th payment? All right, that should be enough time for that part. So let's have a look at this, the answer. So what will Voldemort's final payment be? So remember, in this question, it isn't a perfect amortization loan because it's supposed to be a 4-year loan that based on a 10-year amortization. So that means eventually, for the last payment, you will have to pay off the remaining amount. Right? So if you understand what that means, that just means that you can write this equation. So the present value of 100,000 equals to 47 of the annuity payment. That's what you're gonna make. But for the 48th payment, he need to make a payment such that will be the same as the present value of 100,000, right? So there are two tricks over here. Is first of all to work out, you know that the lump sum of the first 47 is 47 here. So that's power to 47. That tells you the present value of your first 47 payments, and with additional last payment made at the 48th time. And that will be the same as his loan amount. Because after all, that's what his loan structure is like. He will have to pay off the $100,000. So in this case, you can see that it's really just to solve for x in this case. So you can use your calculator to solve the first part, $100,000 minus that, and then times 1.01 power to 48. That will give you the x. And if you use 1434.71, which means you use run it to two decimal places from part C, this is also fine. And that will lead you to slightly different answers. 74,820.63. But as long as your answer is somewhere around that, you'll get a full A marks. Do we have any question on this part D? All right. So I'm just currently watching the chat message, or if you need any help on any of these questions, feel free to do that on the discussion forum. So I will make this available. And just to give you an idea about what people would it be 2 hours allowed for the fine? Yeah, I think at the moment the fun exam will be 2 hours, maybe plus maybe 10 minutes, just because it's going to be an online exam. Like obviously it's not going to be conducted based on Zoom. So Brian saying, could we just use the remaining present value of the loan balance? That's also correct. So you could use the remaining loan balance because essentially, if you understand that, it's going to be an amount that equals to the rest of the term. So what Brian suggests, just use the remaining present value of the loan balance, which is 73 payments left, to compute the final payment. That's also correct, right? All right, you got a different answer to that. So what's this mismatch exam marked out of 90? So for Brian, we could follow up on this on a discussion forum, because I really need to see how exactly you want to do that, right? So sorry, can you explain this? Because I didn't actually write it down over here, but I can explain it on a discussion forum to show you what's an alternative way to do it. Because after all, it's just to figure out what is the remaining payments left, right? So, and for people who use 73 months, you made for Brian, if you use 73 months, here the trick here is that it isn't an exact annuity, because the first payment will be happened on the 48th payment day, right? That is where you might get it slightly differently. Well, all right. So just as a bonus, sorry, the average for this exam in 2018, I believe, was roughly 52%. So which means about, I think the median will be pretty similar to that. So which means about half of people failed in this test. And the highest mark in terms of percentage, right, was about 97%, 96%. So there was someone who get almost 100% in this exam, but there were people who getting 20, 10%. And the average mark was 52%. So if you did better than that, then that's great, because we haven't actually gone through any sort of revision yet. Just as a bonus, right? Feel free to terminate the call if you want, but I'm just gonna show you a few bonus questions from the past year. So this is another question 22. So question 22 turned out to be the slightly harder one, right? So this is question 22 from, I can't remember, maybe from 2017 or 2017. So this just shows you what kind of question can come up in sort of dealing with annuity. So this question is, you can read it. My answer is here. I will just let you to read your question first. All right, so in interest of time, so this question 22 will be going, this particular question will also be made available to on LMS as well. So it just to give you an idea about, so this is in 2017. As you can see that this question, it sounds slightly harder than the question in 2018. So the difficulty level does vary every year. But this part A here essentially makes your life a lot easier. So if you're not sure if you're not sure about when the default is going to be happening, then if you agree to this timeline, when Wendy Darling decides to help you, if you put out agree here, basically that is the timeline for the cash flows involved. So there will be 8 deposits starting from today. There will be 5 university fee payments starting in year 5, year 6, and year 7. So what is the present value of the total university course fees at time 0? And this is the tricky part, because the fee here is currently costing 20K per year and will grow at a constant rate of 4% per year. And this is probably true for many universities today, right? The university fee will just keep growing. Doesn't matter whether you are enrolled in it or not, right? So the trick here is that given the fee is $20,000 now, you will grow 4% per annum. So which means by the time you go to by the time in year 5, the university fee will be 2,000 times 1.04 power to 5. By the time you hit to year 6, will be $20,000 times 1.04 power to 6. By the time you pay your 3rd year tuition fee, that will be 7 years away. That will be 20,000 times 1.04 power to 7. So Naomi, and I feel I was just asking this question saying, will you get this bonus question? Yes, you will get bonus question on LMS as well. So as you can see here, in order to claim this claim the full mark in this question, you need to identify what university fee is going to be growing. And you can use the growing annuity formula. You don't have to, given there's only 3 cash flows. So the present value of that is just going to be a sum of that, right? And the trick is only lies here, that you need to know that the university fee will be 1.04 power to 5 times higher than now. And I also post up alternatively, if you want to use annuity formula, that's also fine as well. But you need to work out what is your first cash flow. So for part C, how much money must his parents put in as the first payment today? In other words, what is D1? So the question here states that his parents want to pay for the entire cost and they decide to start putting funds aside and continuing, and their parents decide to increase each annual payment by 1%. So here, the D series is also a growing annuity, will grow by 1% per year. So what will the first payment be? D1. So the based on present part B, or based on whatever that you calculate from part B, that will be the present value of your fees that your parents need to be prepared to, right? So growth rate is 1%. That means your cash flow D1 is just D1, but cash flow D2 here will be D1 times 1 plus the growth rate G. And given the present value of contribution made by your parents will be the same as present value of fees, essentially you need to write these formulas, which is D1 plus D2 times the present value of a growing annuity formula. And you would go, well, why D1 plus D2? So remember, if you go back to what Wendy Darling helps you, here is that this isn't a growing annuity per se, because your first payment starts from today. So which means that if you remember our discussion in week 4, you need to treat them separately. So which means D2, 3, 4, 5, 6, 7, 8 forms a growing annuity. And D1 happens to be a cash flow right at the start with no time value of money. So if you think about the present value of the whole lot is a combination of 2 components, D1 as well as the rest, then that'll be fine, right? Then that will give you the present value of the whole lot, which essentially was what I write over here, D1 plus that. And the trick in this question is to identify that the D2 can be written as D1 times 1.01. Why is that important? It's important because the question asks you, what is the first payment? What is D1, right? What is D1? It's not asking you what's the present value because you already calculated in part B. It's asking you to calculate what is D1, right? And that's how you solve for D1. You may agree with me that this question is slightly harder than the 2018 version, which is correct. It is slightly harder. And how many more questions? Oh, actually, I have a few more questions over here. So don't worry, this is the last question I'll go through in the call, and you can take a look at this in the online video later on. So for part D, challenging question. If Peter Pan decides to take a gap year after his high school and travels for 12 months, to fund his extra payment, how much as a single payment will Peter need to contribute to the investment account at the start of his degree so that the account will still have enough money to cover all tuition fees? So the trick coming from that, because the university fee grows every year, so if he delays his involvement, this is probably what goes on in your parents' mind as well. So if you take a gap year, if you delay your involvement, that just means the school fee is going to be higher. That just means what your parents previously saving plan, deposit plan, will not be enough. So you will just need to work out, well, what is the new tuition fees like, which is going to be higher than the previous fees. And the difference will be $617.32 in present terms. But the question here is saying, how much as a single payment will Peter need to contribute to the investment account at the start of his degree. So given that he's going to be starting in year 6 years time, then he will need to make the future value of that difference, which is 617.32 times 1.03 power to 6. And that is the final challenge, which is $737. All right, so people keep asking, saying we will have all this document on LMS. Yes, you will be. So I will make all this available in the discussion forum 03 or 04 related to mismatch exam, and I will make an announcement to tell you guys. And once this recording is finished, I will do some editing, mainly just to make sure that I can post it on YouTube as well as Echo 360. Thank you for dining today. This is a one-off, very special, first time for me as well, first time for Daniel, a online mock exam. And I hope if you find it useful, that'll be great. So if you find it useful, give us some feedback. We probably can run more online workshop like this, so we can have sort of like face-to-face Q&A time in the future. And if you did work out most of this question, if you can get more than 50%, then that means you're already beating the average in the past. All right. So I will close the meeting and talk to you soon, either by emails or discussion forum. And have a good day. Stay safe.
Thank you.
Thank you. Thanks for coming.
Thank you.
No worries.
Everyone's going to think that I bought Beats headphones. I didn't buy them.
I will just end the meeting now. Bye.
Sure.